Welcome to this explainer. Look, as an equity research analyst, I see a lot of hype in the biopharma sector. But today, we're putting on our investigative journalist hats and taking a magnifying glass to Insmed Incorporated's Q2 2026 financial explosion. Our goal isn't to just blindly follow the crowd. We are going to look way past the flashy headlines, dig deep into the cold, hard data from their 10Q, and objectively figure out what is actually driving this company's valuation right now. Okay, let's dive into our roadmap. We've got the mandatory disclaimer, the earnings and balance sheet, Brinsupri as the growth engine, pipeline projections, a skeptic's reality check, and finally, the analyst consensus and our verdict. Section 1, Mandatory Disclaimer, Educational Case Study. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Section 2. Earnings and balance sheet. A dramatic shift in financial health. $425.5 million. Let that number sink in for a second. That is Insmed's total revenue for the second quarter of 2026. To put that into perspective for you, in the exact same quarter last year, they generated $107.4 million. That is an absolute undeniable surge in top-line growth. But hey, top-line growth is only half the story in biotech, right? We need to see how efficiently they're actually operating. And this brilliantly illustrates that shift. While R&D expenses climbed to $210 million to back their clinical trials, and SG&A expenses jumped up to nearly $247.5 million to support product launches, the real story here is the net loss row. Look at Q2 2025. They were bleeding cash, posting a net loss of over $321 million. Fast forward to this quarter, and that net loss has virtually vanished, dropping down to just $13.2 million. They are effectively on the precipice of breaking even, completely defying the gravity of their expanding expenses. Furthermore, they're sitting on an absolute fortress of a balance sheet. As of June 30th, 2026, Insmed reported cash equivalents, and marketable securities totaling a whopping $1.2 billion. For a company aggressively expanding its commercial operations and pushing multiple late-stage clinical trials, this provides a massive runway. It means they can fund their pipeline without immediately needing to dilute shareholders. Section 3. Brinsupri, the growth engine. To really understand the economics at play, we first have to break down the medical jargon. Insmed's main target market right now is NCFB, non-cystic fibrosis bronchiectasis. This is a severe, chronic lung disease. Patients suffer from permanently enlarged airways, intense excess mucus, and recurring lung infections that just wear them down. Survey results from the 2026 American Thoracic Society Conference showed that nearly 77% of these patients report a significant decline in their overall health following exacerbations. It's a huge burden, and historically, doctors just had to throw off-label antibiotics at the problem. Enter Brinsupri. Approved by the FDA, this is the very first to-market DPP-1 inhibitor that targets the specific inflammation-causing NCFB. In the biopharma world, having a first-mover advantage with a novel mechanism of action, that creates a massive economic moat. They're offering a targeted, non-antibiotic treatment that is rapidly, and I mean rapidly, becoming the standard of care. And here is what that economic moat looks like in dollars. Brinsupri generated $309.2 million in revenue in Q2 2026 alone. That is a staggering 49% sequential growth jump from just the first quarter of the year. This super aggressive launch trajectory is exactly why management just confidently raised their full-year guidance for Brinsupri to a range of $1.25 billion to $1.4 billion. Section 4. Pipeline projections, mapping the $14 billion target. Now, what's truly staggering about this is the sheer scale of management's ambition. On the recent earnings call, they laid out peak revenue estimates for their 3 lead assets that combine to more than $14 billion. They've raised Brinsupri's peak estimate to over $7 billion. They believe TIPIP, which is advancing in late-stage trials right now, could peak at over $6 billion. And they firmly reiterated that ARIKAYCE remains a $1 billion-plus asset as it seeks label expansions. Because of these massive pipeline projections, management is confidently predicting that the business will reach cash flow positivity in 2027. And while they are technically still operating in a slight net loss today, the aggressive sequential growth of Brinsupri gives some very serious mathematical weight to that 2027 break-even target.
Section 5, the skeptic's reality check, reading the footnotes.
Okay, time to put on the skeptical analyst hat. It is so easy to get blinded by top-line revenue beats, but our job is to read the footnotes. Methodically breaking this down, there are some glaring media blackout flags here. First, global market expansion is hitting a wall. Brinsupri's launch in Europe has actually been delayed. Why? A lack of clarity on the U.S. Most Favored Nation, or MFN, drug pricing policy. Furthermore, that massive $7 billion peak sales projection, it assumes the Inflation Reduction Act's price negotiations won't impact them until 2035. That's a huge assumption. And of course, despite the shrinking deficit, they are still operating at a net loss today. To really prove the severity of this execution risk in Europe, look no further than management's own words on the Q2 call. I quote, "Lack of willingness or interest on the part of most of the European countries because of budget constraints reduces the attractiveness of a traditional commercial approach." They are openly admitting that European budget constraints are completely derailing their traditional international strategy. That is a significant hurdle for a drug banking on global reach to hit a $7 billion peak. Section 6, Analyst Consensus and Verdict, the Wall Street Reality. So the crucial point here is that despite the European launch delays and the hovering cloud of IRA price negotiations, Wall Street is largely unbothered. The street consensus leans heavily towards strong buy or overweight. Following the Q2 report, Morgan Stanley bumped their target up to $218. Truist raised theirs to $195. Even firms that slightly lowered their targets, like JP Morgan dipping to $175, maintain incredibly bullish ratings. Wall Street clearly believes the economic moat Brinsupri is building in the U.S. far outweighs the international static. This leaves us with a stark reality regarding potential upside. With the stock hovering around $125 right now, the average consensus target is sitting way up at $200.05. That implies a massive potential upside of around 59%, driven almost entirely by the belief that Brinsupri is cementing itself as the undisputed standard of care. Which brings us to our final takeaway. The explosive, data-driven growth of Q2 is absolutely undeniable, and that $1.2 billion cash pile offers immense security. The street is screaming strong buy. But, as we've seen, the looming storm of global pricing regulations and delayed international expansion are very real factors. So I leave you with this. Are these international and policy risks adequately priced in right now? Or is the market totally blinded by the U.S. revenue surge? The models point one way, but the footnotes suggest a storm. Do your own homework. Thanks for joining me on this explainer, and I'll catch you on the next deep dive.